Can you imagine running out of money before you run out of time? For many retirees, that's the question that keeps them up at night. How much of your portfolio, your retirement dollars, can you spend each year across a 30-year retirement and not run out of money? That's the question we're going to answer today. The 4% rule is our topic. And if this sounds interesting to you, or you're approaching retirement and wondering how you're going to convert your retirement assets to income that you can live on in retirement, you're in the right place. I'm Mark Tomei. I'm the founder of Hindsight Financial, for the best conversation around hidden and confusing money traps that confiscate your retirement. Subscribe to our YouTube channel, and don't forget to click the notifications bell to get notified when I roll out a new video each week. So, why do we need a 4% rule to begin with? Let's talk about that. Can't we just take the amount of money that we have in our retirement account and divide it by the number of years and just spend that amount each year? It sounds right. It sounds like it should work, and it would work if your money was in a pillowcase. But that's not where we've all been taught and trained to store our wealth. So we have an entire generation of people who have used the stock market and its counterpart, the bond market, as the central storage place for their retirement dollars. So why do we need a 4% rule? Market volatility. So the stock market, as you may have known, can take your money on a wild ride in either direction at a moment's notice. And it all involves hundreds of factors that we don't have any control over. So market volatility is the enemy of the retiree. You have to think you've been saving your entire life and putting money into the account, watching the account grow, hopefully, year after year. Even as it's going down, we're still putting money in. We're still trying to build that account. When we shift to retirement mode, there is no longer new money going into the portfolio. Everything starts to come out. And there's a few adjustments that people are going to need to make or be familiar with to make that transition successful. There's an emotional drain on watching an account that you've built your entire life slowly be spent down. Once new money stops going in, it is now the order or the sequence of returns that you get in your account that's going to make or break your retirement. So where did 4% come from? Obviously, we're discussing safe withdrawal rates of retirement money, but 4% came from somewhere. It all started in 1994 in a study done by a financial advisor named William Bengen. And he used computer technology that was kind of ahead of his time back in the 90s to basically simulate all the different market conditions and all the different sequence of returns that an investor could have gotten from the beginning of the stock market all the way through the date of his study in 1994. And he asked the computer of all of those market combinations, the sequence and the order, if I switch them around, if I get them backwards, forward, what percent can I withdraw safely out of my portfolio each and every year across a 30-year retirement and still have $1 left in the account? That's how we define success. Still $1 in the account. So it's funny that that study is called a Monte Carlo study, and Monte Carlo is obviously a famous gambler. So I always catch the irony in that. So William Bengen determined in his study that if he withdrew 4% in any of those market conditions, he would have success in those portfolios, defined by at least having $1. So that 4% finding became important in financial planning circles, and eventually it became the industry rule of thumb. A few years later, a group of professors conducted what's called the Trinity study of safe withdrawal rates. And they expounded on Mr. Bengen's work and in some cases confirmed his findings, which was a good thing because his biggest concern was he made a mistake and somebody was going to come along and prove him wrong, but that never happened. So how does this work? When I retire to a nest egg of stocks and bonds and cash and a portfolio, that's my complete nest egg. What the 4% rule says is if you withdraw 4% of that portfolio in your first year of retirement and then adjust those withdrawals to keep pace with inflation, then you should have the success and have an account left over at the end of 30 years. The Trinity study went a little bit further to build in more portfolio types and different retirement durations. And as I said, they largely confirmed Mr. Bengen's work. However, through expanding on that, I believe they've tightened it down a little bit, and you can see on the screen now we've got withdrawal rates on the left and then different types of portfolios and their chance of success at that withdrawal rate across a 30-year time horizon. And the first thing that should stick out is if you get above 5%, the chances of success get very grim. So that's a big wake-up call for a lot of people to see that, my goodness, my portfolio is only going to support 3 or 4%. So when we look at these success rates, I want you to pay particular attention to what happens if I'm off by even 1%. You see, in the 4% withdrawal rate, the 75-25 portfolio has a 87% chance of success. You have to decide whether or not that's acceptable for you. Can you imagine getting on a flight and the pilot comes over the intercom saying, "Good evening, ladies and gentlemen. We're on our way to Orlando, Florida today, and we've done some math on our pre-flight checks, and looks like we have about an 87% chance of getting you safely on the ground in Orlando. Welcome aboard." Would you stay on that flight? And I guess most people would say no. So we have to be aware that these challenges are out there, and if we get this wrong, retirement does not offer a lot of do-overs. But pay particular attention to the 4% to 5% jump. So in other words, if I wanted to bring on an advisor to manage my portfolio, because I don't want to build an income portfolio, I don't want to deal with portfolio rebalancing and sales and redemptions and all of that. So I want to bring on an advisor to do that, and the advisor requires 1% of my portfolio each and every year. Take a look at what happens to your success rate when you go from 4% on your own, raising it by 1% to cover your advisor. The failure rate increases by 50%. So very important to understand there is a science behind how to withdraw a portfolio, and this is very important to understand as you approach retirement, or hopefully early in your retirement, somebody shares this with you, because current studies along the lines of Mr. Bengen's study and the Trinity study are always going on, and now we have even more current data and better technology. And they're pointing to a withdrawal rate closer to 2.4%. So we've got to keep an eye on this and make sure that we're doing things in our own lives and portfolios that are not going to subject ourselves to these massive failure increases. So it's kind of a reality check as we wind down. I have a portfolio, but I can't withdraw it all every year. I can't withdraw it in 3 years. So if I need it to last for 30 years and it's in a volatile market portfolio of stocks, bonds, mutual funds, cash, real estate, the typical stuff, that portfolio at $1 million is truly worth, or translates to, approximately $25,000 to $30,000 of gross income. That's before Uncle Sam gets a hold of it. Most people never do this type of analysis. Most people just approach retirement. Maybe they looked at their budget and tighten their belt a little bit, but for the most part continue living the way they're living without ever really knowing that they're in danger. And that's the part I want to bring home in this video. There is a limit if you did build the portfolio that way. Then a safe withdrawal rate is a very important conversation for you to have. And I also want to tell you that there is a better way to do this. So 4% is not the only way. So if anybody has ever explained this to you, drop a comment in the comment section below. Let us know if this is the first time you've heard of it, or if this was something that you were already aware of. So if this is interesting and you want to hear more about this type of conversation, I invite you to check out my free masterclass, The 6-Figure Retiree Primer, with money hacks for the new economy. And that's at www.sixfigureretiree.com. Don't forget to leave us a comment, sign up for our YouTube channel, click the notifications bell. Make sure you get notified when we put out new content. Thank you for taking the time.